Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines.
We've got a lot to unpack today.
Yeah, we do.
From currency fluctuations and a nail-biting tech earnings report to geopolitical tensions that are keeping everyone on edge.
Okay, so let's dive right in. I love a good market puzzle, so let's start piecing this one together. What's the big picture story dominating the headlines today?
Well, it's impossible to ignore the shadow that the Russia-Ukraine conflict is casting over the global markets. CNBC is reporting that investors are clearly reacting to the escalating tensions, particularly Russia's recent warnings about the potential use of nuclear weapons. It's a chilling thought, and it's definitely adding to the uncertainty in the markets.
Uncertainty usually sends investors running for so-called safe haven assets, right? What are we seeing there?
Exactly. And gold is a classic safe haven. Bloomberg is reporting that gold prices are on the rise up for the third consecutive session. This is likely driven by a combination of factors, including geopolitical jitters and the softening U.S. dollar.
Speaking of the dollar, Bloomberg also has a piece about choppy waters ahead for the greenback. After that strong rally fueled by the recent election, is the dollar losing its mojo?
It might be too early to say for sure, but there are signs that the Trump-inspired rally is losing steam. Bloomberg highlights some key market metrics suggesting that further short-term gains for the dollar could be limited.
So what's making investors hesitate? Are they questioning whether a second Trump administration will be as good for the dollar as the first?
It's certainly a possibility. The market is still digesting what a second Trump term could mean for trade and tariffs. Remember those?
How could I forget? Those tariffs always seem to be lurking in the background.
And JP Chase reports that investors were actually net sellers of the dollar last week. This shift in sentiment could be due to uncertainty around trade policy, but Bloomberg also points out concerns about rising inflation. If inflation remains stubbornly high, it could deter the Federal Reserve from cutting interest rates as quickly as some had hoped.
So higher inflation, potentially higher rates for longer, that's not great news for borrowers. But hey, maybe the euro will step up and steal the show. CNBC mentioned that some economists are predicting it could reach parity with the U.S. dollar in 2025. Is that even realistic?
It's definitely a bold prediction, but not entirely out of the realm of possibility. The euro has already declined rapidly since Trump's victory, and if he moves forward with significant tariff increases, it could put further downward pressure on the euro.
So Trump's policies could have a ripple effect across the Atlantic, even impacting the euro. Talk about globalization.
Exactly. It shows how interconnected our financial systems truly are.
Yeah.
And speaking of interconnectedness, let's turn our attention to Asia. CNBC is reporting that Asian Pacific markets are having a mixed reaction to some major developments.
Okay, give us the rundown. What's happening in the East?
Well, investors are digesting a few key pieces of data. First, Japan posted some better-than-expected trade figures for October. Their export growth came in at a healthy 3.1% year-over-year, exceeding forecasts from economists polled by Reuters. It seems Japan's focus on high-tech products and strategic trade partnerships is helping them weather the global economic storm.
That's impressive. While other economies are struggling, Japan's export sector seems to be thriving. But what about China? They're usually a major player in the global economic game.
Right, and on that front, China's central bank decided to keep its benchmark lending rates unchanged, according to CNBC. This suggests a cautious approach from their central bank, likely due to concerns about the global economic uncertainty and perhaps even ongoing trade tensions with the U.S.
It seems those trade tensions are casting a long shadow over everything.
Yeah.
But amidst all this uncertainty, there's at least one company everyone is excited about, Nvidia.
Ah, yes, the tech giant. Their earnings report comes out later today, and MarketWatch says it could really set the tone for the entire market.
Why is everyone so fixated on Nvidia? What makes them so special?
Well, for one, their performance is often seen as a bellwether for the tech sector and the overall market. They're a leader in their field, and investors are eager to see how demand is shaping up for their new AI chips, which are designed to power the next generation of artificial intelligence applications.
So if Nvidia crushes its earnings, does that mean the AI boom is still full steam ahead? And what about the broader market? Could a strong performance from Nvidia lift all boats?
That's what everyone is hoping for. However, MarketWatch also points out that there are concerns about supply chain challenges that could impact their results. Global supply chains are still facing disruptions, and if Nvidia can't deliver enough chips to meet demand, it could impact their revenue and earnings, potentially disappointing investors.
It sounds like there's a lot riding on this report, a lot of hopes and a lot of potential pitfalls.
Mm-hmm.
What are analysts predicting? Will Nvidia deliver the goods?
Analysts are expecting strong earnings growth, but the whisper numbers, those unofficial rumors circulating among investors, are even higher. The market is buzzing with speculation that Nvidia might blow past even the most optimistic projections.
Whisper numbers. I love it. It's like the market has its own secret language. So the bar is set pretty high for Nvidia to impress investors. But before we get swept away by tech hype, let's get back to the human side of the market.
Sounds good. What did you have in mind?
Well, MarketWatch had a fascinating piece on a demographic trend that could have significant implications for the market. Deutsche Bank researchers have found that individuals aged 55 and older now hold a staggering 79% of stocks and equity funds in the U.S.
79%. That's a huge chunk of the market concentrated in the hands of one generation.
Exactly. And as this generation retires, they're likely to shift their investments away from stocks and towards more conservative options like bonds. Could this lead to a mass exodus from the stock market, potentially driving prices down?
It's a valid concern. Demographic trends can have a powerful influence on market dynamics. It's certainly something to keep in mind, especially since the S&P 500 is currently trading at historically high valuations. And speaking of valuations, MarketWatch also highlighted a growing concern. Wall Street is lowering expectations for corporate profits in 2025.
So even with the recent market rally, there's a sense that the good times might not last. What's fueling this pessimism about corporate profits?
A few factors are contributing to this shift. For one, global economic growth is slowing. That means less demand for goods and services, which could translate into lower sales and profits for companies.
That makes sense.
Yeah.
If the global economy is sputtering, companies are going to feel the pinch.
Right. And then there's inflation, which, although it's moderated somewhat, is still a concern. Higher prices for raw materials, labor, and energy can eat into profit margins, further squeezing corporate earnings.
So companies are facing a double whammy of slowing growth and a persistent inflation. Not exactly a recipe for booming profits.
Exactly. And to add to the complexity, there's the added layer of uncertainty surrounding the new Trump administration.
Here come those tariffs again. Are they really going to be that big of a deal for corporate profits?
They have the potential to be a major disruptor. Trump's protectionist policies could disrupt global trade and make it more difficult for companies to do business internationally. On the one hand, his tax cuts and deregulation policies could potentially boost corporate profits. But on the other hand, his fondness for tariffs could spark a trade war, which would be detrimental to many companies.
It sounds like a real tug of war between potential benefits and potential risks. How are investors supposed to navigate this uncertainty?
That's the million-dollar question. And one way to gain some perspective is to look at what other companies are doing. CNBC reported that Comcast is planning to spin off their cable networks, including MSNBC and CNBC. While the reason for this move isn't entirely clear, it's likely part of a broader trend of media companies restructuring their businesses in the face of a rapidly changing media landscape.
It seems no industry is immune to change these days. The rise of streaming services and cord cutting has definitely shaken up the traditional media model. Maybe Comcast is trying to get ahead of the curve before it's too late.
It's certainly a bold move, and it might be a sign of things to come as other media giants try to adapt to these new realities. But let's not get too sidetracked by the media world. There's still a lot to unpack in the world of finance.
Agreed. We've covered a lot of ground already, from Asia to Europe to the U.S. and everything in between. What a whirlwind tour of the financial landscape. But before we get completely swept away, let's take a moment to reflect on what we've learned so far.
That's a great idea. Sometimes it's helpful to step back and synthesize all this information before diving into the next wave of headlines.
Exactly. Let's regroup and digest all these insights before moving on to the next chapter of our market adventure. Stay tuned.
Welcome back to the Pro Ticker Podcast.
We're back and ready to delve deeper into some of the most impactful financial news of the day. Before the break, we were discussing the potential for the euro to reach parity with the U.S. dollar. Sounds almost unbelievable.
It is a bold prediction, but CNBC points to some factors that could make it a reality. One key factor is the possibility of increased tariffs under the new Trump administration. If the U.S. imposes significant tariffs on European goods, it could make those goods less competitive in the global market.
So European exports could take a hit, leading to less demand for euros and a weaker currency.
Exactly. And a weaker euro would make European imports more expensive, potentially fueling inflation in Europe.
That sounds like a tough spot for the European Central Bank to be in, fighting inflation while their currency is weakening.
It definitely creates a challenging economic environment. This situation really highlights how interconnected the global economy is. Decisions made in one country can have far-reaching consequences.
It's a delicate balancing act, for sure. But let's shift gears to that tech giant everyone is buzzing about, Nvidia.
Ah, yes, the market darling. Their earnings report is due out any minute now, and the anticipation is palpable.
MarketWatch called Nvidia a potential bellwether for the tech sector and the overall market. What are investors hoping to see from them?
Well, all eyes are on demand for their new AI chips. These chips are crucial for powering the next generation of artificial intelligence applications. Strong demand would signal that the AI boom is still going strong, which would be good news for Nvidia and potentially for the entire tech sector.
But MarketWatch also mentioned concerns about supply chain challenges. Could those challenges overshadow even strong demand?
Absolutely. Global supply chains are still facing disruptions from various factors, including geopolitical tensions and the lingering effects of the pandemic. Even if demand for Nvidia's chips is sky high, if they can't produce enough to meet it, it could impact their revenue and earnings.
So it's a two-pronged challenge for Nvidia. Prove they have the demand and prove they can deliver the goods. High stakes indeed.
Indeed. And speaking of high stakes, let's revisit that demographic trend we touched on earlier. The fact that individuals aged 55 and older now hold a whopping 79% of stocks and equity funds in the U.S., according to Deutsche Bank research, has some investors worried.
79% is a staggering figure. It really puts into perspective how the aging of the U.S. population could reshape the financial landscape.
It's a major demographic shift that could have a significant impact on how assets are allocated in the coming years. As this older generation retires, they'll likely start shifting their investments away from stocks and towards more conservative options like bonds.
Makes sense. Retirees generally prioritize preserving capital and generating income over the higher growth potential, but also higher risk of stocks.
Precisely. And this shift could potentially put downward pressure on stock prices, especially considering that the S&P 500 is currently trading at historically high valuations. This demographic trend, coupled with the lowered profit expectations for 2025 that MarketWatch reported on, has some analysts concerned.
It sounds like a perfect storm brewing. High valuations, slowing economic growth, and a massive demographic shift away from stocks. Are we headed for a market correction?
It's certainly a possibility, although it's impossible to predict the future with certainty. But these factors are raising red flags for some market observers. And to add another layer of complexity, there's the ongoing uncertainty surrounding the new Trump administration and its policies.
It seems like those tariffs are always looming in the background, casting a shadow of uncertainty over the markets.
They are a major wildcard. Trump's protectionist stance could disrupt global trade flows, making it more difficult for companies to operate internationally. This could further dampen corporate profits, adding to the headwinds the market is already facing.
So we have a mix of long-term trends like demographics and slowing global growth and short-term uncertainties like trade policy and the potential for a market correction. Yeah, it's a lot for investors to digest.
It certainly is. And it highlights the importance of staying informed, being adaptable, and maintaining a well-diversified portfolio.
Well said. But before we spiral into market anxiety, let's take a moment to highlight a potential bright spot amidst all this gloom. Remember those better-than-expected trade figures that Japan posted for October?
Yes, CNBC highlighted that as a beacon of hope in an otherwise uncertain economic landscape.
Their export growth defied expectations, coming in at a healthy 3.1% year-over-year. What's fueling Japan's export success in the face of global economic headwinds?
It seems their focus on high-tech products and strategic trade partnerships is paying off. Despite slowing growth in other parts of the world, Japanese businesses are still finding buyers for their products, showcasing their resilience and adaptability.
It's a reminder that even amidst global challenges, there are always opportunities for those who can adapt and innovate. But let's not get too carried away with optimism just yet. We still have a lot to discuss.
Indeed, there are always more angles to explore and more insights to uncover. Let's take a quick pause to gather our thoughts, and then we'll delve even deeper into these market dynamics.
Sounds like a plan. Stay with us. Welcome back to the Pro Ticker Podcast.
We're wrapping up our deep dive into today's financial headlines.
Yeah.
But before we go, let's take a step back and try to connect the dots. What are the key takeaways for our listeners?
Well, we've covered so much ground, from geopolitical tensions to a potential market correction, and even a glimpse of hope from Japan's strong export numbers. It feels like the global financial landscape is in a constant state of flux. What should investors be focusing on in this turbulent environment?
Well, one thing that stands out is the importance of staying informed and adaptable. The markets are reacting to a complex web of factors, from the Russia-Ukraine conflict and Trump's trade policies to shifting demographics and slowing global growth. It's a lot to keep track of, but it's crucial to understand the bigger picture and how these events are interconnected.
That makes sense. It's not enough to just react to headlines. Investors need to understand the underlying trends and forces shaping the market. But what about specific opportunities? Where do you see potential for growth amidst all this uncertainty?
One area that continues to offer promise is technological innovation, particularly in the field of artificial intelligence. We talked about Nvidia's new AI chips, but they're just one example of how a technology is driving growth and creating new possibilities. Investors who can identify companies at the forefront of these trends could potentially reap significant rewards.
So tech and specifically AI is still a hot sector to watch. But with all the hype surrounding AI, it's probably important to be selective and focus on companies with strong fundamentals and a clear path to profitability, right?
Absolutely. Not all tech companies are created equal. It's crucial to do your research and separate the hype from the reality. Look for companies with a proven track record, a solid business model, and a competitive edge in the market.
And what about the risks? We talked about the potential for a market correction,
Hmm.
but are there other threats investors should be aware of?
One risk that's often overlooked is complacency. It's easy to get caught up in the euphoria of a bull market and become overconfident. But markets are cyclical, and what goes up must eventually come down. It's important to have a plan, stick to your investment strategy, and be prepared for the inevitable downturns.
So don't chase returns or get swept up in the latest market frenzy. Instead, focus on the long game, diversify your portfolio, and manage your risk. Sounds like sage advice, pun intended.
Indeed. And speaking of sage advice, one of the most valuable insights we've gleaned from these headlines is the profound impact of demographics on the market. The fact that older adults hold such a large portion of stocks and equity funds means that their investment decisions will have a ripple effect throughout the market in the coming years.
As this generation transitions into retirement, we could see a significant shift in asset allocation, with more money flowing into bonds and other conservative investments. This could create a headwind for stocks, especially if it coincides with a broader economic slowdown or spike in interest rates.
Exactly. Demographic trends are powerful forces that can shape the market in profound ways. Investors who understand these trends and position their portfolios accordingly will be better equipped to navigate the challenges and opportunities that lie ahead.
It's a reminder that the market is not just about numbers and algorithms, but also about people, their life choices, and their investment decisions. And speaking of people, let's not forget the human element when it comes to analyzing market trends.
That's a great point. Market psychology plays a huge role in how prices move and how investors behave. Fear, greed, and other emotions can drive irrational decision-making, leading to market bubbles, crashes, and everything in between.
It's like the market has a mind of its own, driven by the collective hopes and fears of millions of investors. Sometimes it feels rational, and sometimes it feels completely unpredictable.
And that's what makes it so fascinating and challenging. Understanding human psychology and how it interacts with market dynamics can give investors a valuable edge. By recognizing patterns of behavior, managing your own emotions, and avoiding common cognitive biases, you can make more informed and rational investment decisions.
It sounds like we've come full circle back to the importance of staying informed, thinking critically, and continuously learning. The financial markets are constantly evolving, presenting both opportunities and risks. Investors who can adapt, learn, and make informed decisions will be best positioned to succeed in this ever-changing landscape.
Well said. And on that note, we'll wrap up this edition of the Pro Ticker podcast. We've explored a wide range of financial news, from currency fluctuations and tech earnings to geopolitical tensions and demographic shifts. Hopefully, you've gained some valuable insights that will help you navigate the complexities of the market.
It's been a fascinating deep dive into the world of finance filled with thought-provoking analysis and insightful commentary. We hope you've enjoyed the ride.
And we'll see you all tomorrow morning with new headlines from major financials magazines.